Welcome out to the Blue Sky Trading Lab every Thursday. Every Thursday, 4 p.m. Eastern Standard Time. Every single week, guys, what we like to do in this lab is we like to work on our skill set. We like to work on techniques and typically on the technical side of the equation. In the last few weeks, we've talked about moving averages. We've talked about how to use moving averages, the structure, the types of averages you should be looking at. We've talked last week about MACD, RSI, and some of those traditional indicators. We're going to continue that indicator conversation here today with a little bit of a conversation on stochastics. Now, stochastics is an oscillating indicator, like many of the indicators, similar to RSI in the sense that it oscillates between 0 and 100. Now, when you're looking at stochastics, guys, it's an indicator that reads momentum and other things very similar to a lot of the other indicators. Momentum is one of the more important things to truly understand in the market. And so every single one of these indicators is going to help with momentum. They're going to help with understanding overbought and oversold zones. And like most indicators, when you do use an indicator as a secondary confirmation tool, it's confirming what you're seeing on the price chart. You see a trend, bullish uptrend. You have a bullish breakout, RSI above 50, underneath 70 with the positive hook confirms your decision. You have a bullish retracement, MACD slowing down, histogram crosses back up above the zero, bullish confirmation. When you're looking at stochastics and you're saying, okay, that looks like an oversold bounce. Well, are you oversold on stochastics? Every single indicator has a different purpose. They all help us understand the technical environment. They're all there to help us understand our read on the price. And they're there to provide us secondary confirmation, which is extremely key. Secondary confirmation is what confirms that decision to get in or to get out. And so the first thing I want to talk about here today, guys, is just the definition of stochastics, the tradable signals when you use stochastics. And then I want to look at the market today and see how the indicator could have helped us understand the tradable situations from today's price action. Plan on right around 45 minutes in the lab here today. I do plan on leaving time after the conversation, whatever topic we have, to open up for Q&A on any topic, really, whether we're talking about the indicators today, what we talked about last week with MACD and RSI, the week before with moving averages, or anything under the sun. We'll leave a little bit of time at the end of the lab here today. So when you're looking at stochastics, guys, stochastics, it's an oscillator that oscillates between 0 and 100. Now, at the core of this indicator is it's showing us where the price is trading within its recent range. So what it does, it's not like the pure momentum of MACD and RSI, which are really utilized for a lot of momentum analysis. It's not just about the momentum with stochastics. In fact, if you're using stochastics purely for momentum, I think RSI is better for momentum. I think MACD is better for momentum from a momentum perspective than stochastics is. When you're looking at stochastics, it's really about understanding where the price fits within its overall range. Are you overextended coming into a pivot point, or you're overextended to the downside coming into a pivot point? And so when you're looking at the formula, what it does is it's calculating the recent close to the lowest low and the highest high to the lowest low. It's calculating where you're at within the overall price range. And it can be really helpful for a couple different technical patterns. Number one, it can be really helpful on pullback analysis, guys. Market's overextended, you're anticipating a pullback. It can help you understand that pullback language. I also think it's really good for reversals. And that's where it can be a little bit complicated is, are you dealing with just a pullback or are you dealing with the reversal? I don't think the indicator itself can answer that question. I think the indicator can simply help you understand the environment where you would be expecting a pullback or a reversal. It's the price that is really important to understand when you're trying to assess, well, is that just a pullback or is it something more? We were having a conversation in the closing hour here today. The market was slightly overextended to the downside. A couple of people are like, "Hey, listen, I'm going to take that reverse trade," and I was like, "Well, I'm going to let the trend play out." That's the subjectiveness of traders who are looking at the exact same thing, agree on the exact same price, but they just have a different interpretation or a different time frame. And the beautiful thing about trading is, depending on the time frame, both certainly can be correct. So let's get into the calculation a little bit. When it comes to stochastics, guys, you're going to be dealing with an oscillator between 0 and 100, and there's two lines on that. The two lines are, and you can always think about these lines in RSI and MACD and stochastics. You can think about them like moving averages are, that they track an average price over time. Now, does stochastics serve a similar function to Bollinger Bands? I would say yes, and that's why I was going to talk about them simultaneously here today. And we can certainly pull up Bollinger Bands to do a little bit of cross look at what stochastics would be reading us versus what we would be seeing on the Bollinger Band. But I would say all indicators in some shape or form kind of overlap one another, is what I would say. There's some commonality in every single indicator, because every single indicator uses price action. Now, the difference in the indicator is a lot of times is the way you will adjust the settings, for example. And so, for example, when you deal with stochastics, and yes, they both give you an overextension, right? If the price is going above the Bollinger Band, you can certainly see that as momentum, but you also see it as overextension that you don't want to chase, that you would want to let set up in a different pattern. I think you can say the same thing with stochastics. When it gets above 80, if you like the price, you like the price. But if you get above 80, a lot of times you're kind of like, all right, you're in a slightly overextension zone. And so I think all indicators will give you that slight overextension. Some do it better than others. I think the best indicator to understand overextension is stochastics and RSI. I think those two are really good on extensions. I think Bollinger Bands is really, really close in that conversation. I think you could see it from a natural price perspective, but there's all going to be some commonality. What I've liked to do over time is try to find where these indicators kind of fit my systems, and how I can utilize them to confirm the way I see the market. For example, I love RSI on a breakout. I just love using RSI on breakout analysis, because the breakout, the number one question you have going into a breakout is, does the stock, does the ETF, does the commodity, does the futures, does the forex, whatever it is, does it have legs to run? Do you have room to run on top of the price action? Can you catch momentum in that environment? And RSI does a really good job, in my opinion, of giving that secondary confirmation tool in helping us understand whether or not we do, in fact, have room to run. I think stochastics is a wonderful indicator for that as well. But they all use historical price, and so they're all going to give a little bit of a similar read. Some are better on momentum, some are better on extension, some are better on triggers. And it's really about how you utilize these to fit within your system, quite frankly. I find myself using MACD and RSI more than I find myself using stochastics and Bollinger Bands. And it's not because RSI and MACD is an end-all be-all better indicator than stochastics and Bollinger Bands. It's just that the way I parse information, the way I parse price action, the way I see technical analysis in general, I think MACD and well, I don't think I know MACD and RSI has a better ability for me to give me that secondary confirmation. Is it for you? Is Bollinger Bands better than RSI? Is Bollinger Bands better than stochastics to help understand those extensions? I think they're both really, really, really good. And I think you certainly do understand it. They serve a similar function. I just think you're going to find yourself using one or the other and not using like 4 indicators to confirm a price trigger. You know what I mean? And that's the thing with the indicators, that a lot of times traders like to use 3, 4, 5 indicators to confirm a decision they're trying to make on the price, because they think if they can get all these indicators to align, it's going to be fantastic. And the truth is they don't all align. And if you need 3 indicators to confirm secondarily your primary decision on the chart, most likely you're going to be late and miss the move, is what most likely is going to happen. So what my goal is to increase the knowledge base of the community regarding these indicators, so that you guys can start utilizing them and see which ones fit best for you. Now, in stochastics, very quickly, I thought that was a wonderful question, by the way. In stochastics, what you got to understand of the moving averages is the percentage K line and the percentage D line. Now, the percentage K line is kind of the main line. It's the main line that's plotted. It's the primary moving average within the structure of stochastics. Now, the question ultimately is what period to utilize from a calculation perspective. And right here, you see 14. What that does is track the last 14 bars, the same way RSI tracks the last 14 bars. Now, the reason we talked about this last week with RSI, we really don't want to change that 14-day calculation on RSI typically. And the reason being is that is primarily the one that most people utilize from an RSI perspective. And the reality is, in trading, guys, there's a self-fulfilling prophecy to technical analysis. It works because people use it. That's the self-fulfilling prophecy. And if I use certain parameters on traditional indicators that, are just unique to me, they're giving me a unique signal, but I'm the only one who uses it, which means there is no self-fulfilling prophecy, which means I want to use, what's up, Rafi? Good to see you, my friend. What I want to use is the same type of calculations that others use in the market, specifically from an indicator perspective. And I'm only talking about the traditional indicators of RSI, MACD, stochastics, and whatnot. So the percentage K is you have a decision to make. Number one, do you use 14 periods or do you use 10 periods? And the difference is really, really important. If you use a 14 period, it's going to smooth out the indicator a little bit more. Let's go ahead and let's look at the indicator very quickly. So when you use a 14 period here, and the top indicator you see, not there, that's volume, but the top indicator you see is the 14 period stochastics fast indicator. Well, if I add another indicator to just kind of look at it in the similar light, let's go to stochastics, let's add a fast indicator, and let's put that as a 10-day. Okay, so we got a percentage K 10-day, we got a percentage K 14-day. Now, what you're going to see here is on this indicator using 10 days, and this indicator using 14 days. Okay, this one's 14, this one's 10. And so what you're seeing is you're going to see a little bit more sensitivity to price action on the 10-day than you will the 14-day. And so one of the triggers is when the percentage K line, which is the red line, crosses over the smoothing line, which is the percentage D line. That's a trigger. So on the 10-day, that trigger happens one candle in front of the 14-day. And so that trigger there will show you on the 10-day, it will show you that cross faster than what you will see on the 14-day. And you're seeing it play out right here. You saw the price tick down, and what happened to that 10-day? That 10-day moved fairly aggressively, whereas the 14-day did not. And so the scalpers out there typically like to utilize a shorter time frame on their stochastics than, say, traditional, what I would describe as a traditional day trader. And so the day traders are really kind of calculated, in my estimation. This is just how I parse day traders. I give them 3 time frames. You got the day traders who are scalpers, and they are in trades fast. They're in and out fast, constantly trading, constantly scaling, and you see that every single day with Mike. Mike is just fantastic at doing that every single day. But he doesn't always just scalp. A lot of times he's going to hold a trade for a good 2, 3, 4 hours if the price is moving. That's more of a traditional day trade when your setup is done on a 15-minute chart and you're willing to hold for a few hours. That's kind of that traditional day trade. For those traditional day trades, a 14 days is probably a little bit better. And so if you're scalping, 10-day contract or a 10-day indicator is probably a little bit more sensitive and does a little bit better for very short-term trades. Whereas on a more of a traditional standpoint, you might want to use a 14-day. Now, the second thing, and we're going to use the 14 here for our purposes here today. So I'm going to take away that other one, just take away that 10-day right there, apply. Now, the second question on stochastics that a lot of people have is outside of just the pure understanding of the indicator and the calculation. So once again, you have a percentage K line, which is the standardized time frame for the moving average of percentage K. That's 14 or 10. We're utilizing a 14. Percentage D is known as the smoothing line. And what the smoothing line does is it's a 3-day moving average of percentage K. And so it's going to lag percentage K. Percentage K leads, percentage D lags. And so percentage D is always 3. It's always 3. It doesn't change. You don't change it. It's always 3. Now, if you're a very aggressive short-term trader, you can use an EMA in there in the calculation of percentage D, but for the most part, it is a 3-period simple moving average of percentage K. Now, the two types of stochastics, and these are going to be the exact same parameters on them, but the two types of stochastics you have, and it once again kind of goes to the conversation of, do you use a really fast stochastics? Do you use a slower stochastics? Let me ask you guys a question. Who here sees themselves as a very quick trader? You want to get in, you want to get out, you want the fastest indicators, you want the fastest confirmation, you want speed. Blas, you want speed. Who's like Blas? You want the speed. You want to get in, you want to get out, you want to see those scalps. Who's there? Okay. You're going to want to use a faster one, right? Now, faster means you're also going to get more mishits on the indicator. We all know that, but okay. If you are that individual that prefers the speed of things, okay, you're going to want to use that fast stochastics. That's the top one here. And as you can see, it's a lot more sensitive to price. You get more crosses, you get more hooks, you get more everything. And so you're going to get more data. And the more data you get, the more you can do something with it. It gives you a much quicker read. But because it gives you a much quicker read, a lot of times the hooks don't actually mean anything. So if you're going to use that faster one, make sure you not only get a hook, but you get that cross, because you're going to get some misfires on that. Just wanted to be clear on that. Now, who here is more of the more slower, methodical? You want the time frames to align. You might be in a trade 2, 3, 4 hours type scenario. Who here is like that? That's more like me, by the way. Okay, me and RQ. Are we the only slow, methodical, multi-time frame here? Pajama speed? That's right. That's right. Now, Gabbard, it's all about time frames. You see me every now and then. I'll go shorter time frame. I'll scalp. Absolutely. It's not one is better than the other. It's knowing who you are, right? It's trading, and this journey in trading is a constant evolution of trying to understand who you are and how you interact with the price action, right? And sometimes the market is very sensitive to price, and I might be very quick on the price. And so other times it might be a little bit more methodical, slow day, and I might want to be a little bit more slow and methodical as well. I have said this before, but the way I kind of navigate it is I don't have one end all be all. I like to match the volatility of the market. If the market's acting fast and volatile, I'm gonna try to match that speed. I want to match what the market's doing, but I typically do like a little bit more smoothed out indicator. And if you do like a little bit more smoothed out indicator, not only can you use the 14 period on K on the fast stochastics, but you can also use a slow stochastics as well. The slow stochastics uses the exact same time periods. However, it will use a slower, methodical smoothing out period. And as you can see, we don't get as much crosses, we don't get as much hooks, you don't get as much, mishits. But what you do get is you're slower to the reaction. For example, the slow stochastics right now is the faster one's hooking now. The slower one just hooked a little bit ago. And so it's just important to understand here, guys. I like using the fast stochastics with the slower level, meaning fast stochastics with the 14-day period. I have no problem with the slow stochastics. It's a good read too. I'd like it the happy medium. I don't use the fastest settings. I don't use the slow. I like using the fast stochastics when I do. And so we're going to just go ahead and take off that slow. I just want to explain it because I get a lot of questions when I'm talking about stochastics, what version to use, because there are multiple versions. And when you're talking about the fast stochastics, it's really just a matter of what period do you use on percentage K. Do you use the 14 period? Do you use the 10? Either one is good. One smooths out the data a little bit more. That would be the 14. Now, the first thing to understand on stochastics is the zones of overextension and the zones and what they mean. Because simply because something gets above 80 does not mean sell, guys. It does not mean sell. I want that to be very clear. When something gets above 80, it does not mean sell. It means you have momentum. You have a lot of momentum moving to the top side. When something gets underneath 20, it does not mean automatically buy. It means you have momentum to the downside. What it also means is you're in an environment where patterns could develop here. And so I'm going to get into that here in just 1 second. Now, one of the most popular ways to use stochastics is just the general understanding of the overbought and oversold zones. Your overbought zone is anything above 80. Anything above 80 is overbought. Now, unlike RSI, where in between it really mattered to us, like if you have a positive hook above 50 and you're underneath 70, that's confirmation on a bullish breakout. You got a negative slope underneath 50, above 30, that's a confirmation on a bearish breakdown. That's not the case here. There's not a big thing to say about, well, what if you get a hook at 50? That's not really anything here. We're not really focusing on those hooks and crosses. If you're focusing on hooks and crosses, focus on MACD. Much better on the hook and the cross. MACD's hook and cross is infinitely better in my estimation than the stochastics hook and cross. So we don't want to pay too much attention to the indicator in between the 20 and the 80 zone from a hook and a cross situation, because that's not a really great read on stochastics in my estimation. It's really when it's at its overextension levels that stochastics becomes something a little bit more valuable. So the signals are stronger when we're crossing underneath 80, not underneath 50. The signals are crossing not when we get under 20, but when we get back up above 20. For example, when you're looking at the indicator right now, and we see this, let me get my Epic pen here. So when we see this indicator right here, and it's kind of dancing this 20 level right here. Now, you're overextended to the downside. You're kind of dancing that 20 number. I know I'm overextended to the downside. What's price doing here? This just a couple days ago, by the way. This is the Tuesday night pricing when we saw that breakout on Tuesday night. So the indicators overextend to the downside, prices consolidating in a really tight range. I know we're overextended to the downside at this point, and I know prices consolidating at that level. What that tells me is once we get a breakout, I know the indicator is going to confirm that. That's what I know. That's what the indicator has given me confidence on, is to be able to project that once we get that breakout, we're going to have a very good situation. And so when you're looking at the indicator being underneath 20, I wouldn't be too aggressive every time it hooks above 20. Again, indicators are always used in conjunction with price. And so with price, you're reading price as a short-term consolidation, and then that thing breaks out. Well, here you get that early confirmation right here on this candle. On that candle, when we hook up above, underneath 20, you're hooking above across the percentage D line, all of a sudden you start getting that momentum. And that gives you confidence so that when it breaks this little level right there, or it gets above that candle high right there, or you get that hammer right there and you secondary confirmation here, anywhere right there on these candles, which are 30-minute candles, any one of those could be a trigger candle above the high of that day of that specific candle. Because you're overextended to the downside, you know the indicator is going to confirm. That gives you confidence that once you do get that trigger, you do have the ability. You don't know it's going to happen. You just know you're coming from an overextended zone and the price is giving you a pretty good situation. Now, as price goes up, 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 you get overextended officially right here. Now, a lot of people early on when they start learning stochastics and the indicator gets overextended, they immediately think that's overbought. It's extended, but it's not overbought. Stochastics can live above 80 for an extended time frame. Remember, it's just showing you the momentum within price ranges. And so as that momentum is going up, 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 it's showing you that the bulls have that momentum. And a lot of times when something gets above 80, traders will be like, oh, now that's overextended. I need to get out. That's not what the indicator's telling you. It is not telling you to get out. In fact, it's telling you you have momentum. It's only when the indicator crosses underneath 80 on the downside where the indicator is now telling you you have a confirmation sell. And it's also there. So to the bull that is trading on the top side, you bought the breakout or you bought the trigger on the indicator, either one, you got that momentum. It's up, 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 up. Well, as it comes down, that buyer is most likely going to be out. They probably trailed their stop loss when it was overextended, and they probably got stopped out on this move to the downside. Well, at what point does that trader stop the buying process and hit reverse and start thinking about this from a fading perspective, meaning they're going to fade that initial price movement to the top side? That occurs when you get underneath that 80 barrier. So once you get underneath that 80 barrier and you officially get it right there, right on this candle, at that point, you know the indicator is going to confirm any decision you have to the downside, which means anytime you break a support level, whether that support level is right there, that support level gets broke, or this little support level right here, once that gets broke right there, either way, it really doesn't matter to me if the indicator is at 70 on the downslope or if it's at 50 on the downslope. Once you get underneath 80 right here on the overextension, you then have that confirmation back to the downside, and you're going to basically have that philosophy until you once again get down to 20 and get into that overextended zone to the downside. And so how we read that overbought and oversold is simply because it gets overbought does not mean we stop buying. It doesn't mean you get out of your bullish trade. It means you have momentum in your bullish trade. Where does that momentum cease? It ceases not when you have the indicator just kind of consolidating at the top. What's happening to price? Still going up. Price is at the top end of the range. It's not coming back down. Price is still finishing towards the upper end of the range, upper end of the range, upper end of the range. That's the momentum. But once you see it starting to come down, again, not a concern yet. The concern is when it gets under 80. When it gets under 80, that's the technical confirmation. Now, when this indicator was created, in a nutshell, what the author of the indicator said was, I'm willing to give up the first 20% of a price movement, and I'm willing to give up the last 20% of the price movement, meaning it sells when it gets back under 80, not when it gets above 80. So what the author of the indicator wanted to do, and this is back in the 1980s, is they said, I'm going to buy when it hooks above 20, and I'm going to sell when it gets underneath 80. And that way I can capture 60% of the overall price movement within that range, whatever that range is on the market at that given moment. And so what we do is we look at it very similar, but obviously we're not just trying to trade the indicator. Indicators are secondary confirmation tools. We trade the price. The indicator gives us the confidence to have the read on that price. Now, the second thing you got to look at, and I do think it's better on the slower stochastics than it is on the faster stochastics, but is crossovers between percentage K and percentage D. And so when you have crossovers, when percentage K crosses up through percentage D, that's a buy signal. When percentage K, once again, the red line versus the white line, the red line percentage K, the white line percentage D, when percentage D, when it crosses down through percentage D, i.e. right here at that 20 period, crosses down under 80, crosses down not only under 80, but underneath that smoothing line on percentage D, that's a sell signal as well. So you get the hook, the cross, the hook, the cross. Those are very similar to what we see in MACD. Once again, it's not to me just the hook and the cross. The hook and the cross is really, really good on MACD. It's really about the hook and the cross at a certain zone. And that hook and the cross underneath 80, that's the signal. The hook and the cross above 20, that's the signal. Whereas on RSI, if you hooked above 50, that was a positive situation. That's a pullback situation. That gives you confirmation on that pullback situation. If you do it here on stochastics, it's not really saying that. And so crossovers within the middle of the range can be secondary confirmation as well, but you don't anchor to those crossovers the same way you would anchor to a crossover as it does cross underneath the 80 barrier. Does that help understand kind of the triggers here and the understanding of stochastics a little bit, guys? Does that help in understanding the indicator? Okay. Now, what I want to do, guys, is I want to go look at the pricing today. And I want to take a look at how stochastics could have given us a helpful secondary read on the price action today. Now, the best use cases for stochastics are, in my estimation, timing pullbacks during trends. And what I mean by that is when the trend gets overextended, waiting for that pullback to occur. It gets overextended, stochastic confirms that overextension, waiting on the pullback. Second, fading the overbought and oversold zones. A lot of times I'll hear traders say, I'm going to counter trend trade. And I'm like, okay, you can certainly do that, but make sure you get your confirmation. And what I mean by that, guys, is you don't want to counter trade against momentum. Like it's one thing to counter trade when the bulls give up momentum and you want to jump on the bears during the pullback. That's one thing, and that's perfectly viable. In fact, that's high quality trading. However, on the flip side, you should never go against momentum. If the market has momentum, it has momentum for a reason. You shouldn't be going against that momentum. And that's the flaw I see with people and utilizing stochastics is once it gets above 80, they think that's okay. It's overextended. Let's fade that. Really? You're going to fade that type of momentum? No, you fade when the momentum ends. That's when you fade it. You fade when the momentum comes out of the equation, and that happens not when it's at 98, meaning it can only go up to 100. That happens when it turns over and crosses underneath 80. And so once again, fading those overbought zones is important to understand, but it should only be done when the momentum ceases, and indicators can really truly help you understand when that momentum ceases. I see it on the custom indicators that I see on Mike's charts all the time. We saw those divergent patterns just a couple of days ago, for example. You see these things happen all the time across every indicator. Don't go against the momentum. Let the momentum play out. Either jump on board the momentum or let the momentum play out, but certainly don't fade the momentum. You fade the momentum when the momentum ceases. And when that momentum ceases, well, if you're utilizing stochastics, the indicator's pretty clear on that, guys. It's been the same for 40 years. When it gets under 80 is the official conclusion of the momentum within that price range. And so fading price is going to be an important skill set. Utilizing indicators to help you understand when that momentum is shifting can be very, very powerful. Now let's kind of go into the market today, and let's look at the market here from an indicator perspective. And we're going to be using the fast stochastics, and we're going to look at just kind of the overall price action from the open to the close here today. just utilizing stochastics, not even really kind of looking at the price. We'll look at the price in conjunction with stochastics. So you had the cash open here today. Cash opens right here. Had a lot of volatility before the cash open. Before the cash open, you had the Europeans announced monetary policy. They lowered the interest rates. I think 0.25% is what they lowered interest rates. They're going to be lowering interest rates further as well. But you had that European news that came out this morning had a lot of volatility. And then you had an initial claims report this morning that basically put a little bit of concern on the labor market here today. You had a very negative ADP report yesterday, 33,000 jobs created. The expectation was over 100,000. You had initial claims today come in above 245. Expectation was, I think, 237 in that ballpark. And again, with the ADP report yesterday, that kind of put a damper on the labor market and really put labor market news tomorrow, guys. Very sensitive labor market news tomorrow. I can tell you, after ADP on Wednesday, after the initial claims report today, we get labor market news tomorrow, and that jobs report tomorrow is going to be extremely sensitive in my estimation. Expect some volatility around that tomorrow. Now, when you're looking at the price action after those economic reports happened, and we kind of come into the cash open here, we had a negative cash open. Now, stochastics in the middle of the range crossed underneath 50 on that negative cash open. Was that a confirmation sell signal according to stochastics? Yes or no? Right here. Is that a confirmation sell signal? Yes or no? What do you guys think? F says yes. Let me see a couple other responses here. It would have been on MACD. Yes. Remember, the stochastics in the middle of the range, does it really provide much of anything for us? There's better indicators when within the range here. I would agree with Gabber. So it does, F. It does confirm it. Yes. Yes. You got a cross. It got under 50. It is. It's not the same signal that you would have got on MACD or RSI, quite frankly. And so it would officially, Riz is right, it would officially be a no, because what we're really using stochastics for is not to try to find an edge in the middle of a range on that. We're trying to find the edge at the extension of the ranges. Does that make sense, everybody? Okay, so price certainly did, right? Price certainly did. Other indicators would have confirmed it, but I'm just talking about stochastics. So the answer is obviously it would have confirmed it, but according to stochastics, we're looking at something different. Now, stochastics comes down, 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 and officially gets underneath 20 here. And as it gets underneath 20, guys, that the momentum's still coming out, still coming down, 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 down. Now, you start to flatline here at a key level of support, right? You start to flatline at a key level of support here. That key level of support, the 5960 level, that kind of got hit a couple days ago, but that level is kind of the low point of the day so far. And what? Stochastics kind of underneath that 20. Now, are we going to break down and continue that momentum? Or are we going to break up and see and start to go back up to resistance? Well, here on the indicator, once it crosses back up above 20, what happens? We get that confirmation on the indicator, and the market goes right back up into the highs. Now, as it gets into the high range, it kind of comes over here into the high range over here, gets into that high range. Indicators overextended as it gets into that high range, kind of hesitating. You're overextended, you're overextended. And what happens? Well, the longer it stays up there, the 9 EMA catches up to, and you're like, okay, you better giddy up and go, because if you don't giddy up and go, you kind of know what's going to happen. Once that 9 EMA, and I want to kind of get into this one a little bit, because that 9 EMA is, as you guys know, I anchor against it as the number one momentum indicator in the market. And as that 9 EMA catches up to the price, this is where the price is going to start moving. Either you're going to get that breakout or you're going to get that fake out. Because once that 9 EMA catches up, you're overextended on the indicator. Now you cross underneath the 9 EMA, the indicator crosses underneath even before you're kind of hovering up here, indicator crosses right there. Now we get underneath the 20 barrier right there on that candle, and thus does this right here confirm a sell signal? Yep, it sure does. And all of a sudden, right back down to support. The story of the market today is actually a fairly simple one. Resistance to support to resistance to support. And that's kind of what we saw all day long. And what we saw on the indicator was a very similar situation. Now we've got a situation where we're overextended and we break back up to 20. And all of a sudden we start climbing up the stairs. Now indicator gets above 80, doesn't have the muster though. This is a pretty good situation here to read here. Your indicator gets above 80, but you're now forming a lower level of resistance. And once you crossed underneath that, that's a good signal right there. You cross underneath the 80, you form a lower level of resistance. You confirm that lower level of resistance. Now, this one had a chance to break. It did. You formed a lower level of support, screaming into that support level, gets slightly overextended, and then just hammer candle. This had a chance to break and run, though. It just didn't. Hammer candle came right back up. Another lower porch, gets overextended to the downside. This was that short trigger we were talking about earlier today in the last hour of the trading session, when you broke this support level and the secondary indicator was crossing down as well. That's pretty good little trigger right there. Snapback retracement comes back up. So when you're looking at the indicator here, guys, your decisions to trade are always done based on the price itself. You're always focused on price. Your job as a trader is to master the concept of price. What these indicators do is they give us secondary confirmation to help us understand the environment. Are we overextended? Are we extended to the top side? Are we extended to the low side? Are we at a support level? And what's the indicator giving us that read on? Now, my goal over the last couple of weeks, guys, has been to constantly increase our knowledge base on these secondary indicators. I started with moving averages a few weeks ago, talked about MACD and RSI last week, wanted to focus on stochastics this week. We're going to continue that next week as well. We're going to work into Bollinger Bands. But does this session help you understand and utilize the stochastics indicator a little bit more? You know, whenever we do this lab, guys, I always have two goals. I always have two goals. Number one is to increase everybody's knowledge wherever you're at, whether you're a professional trader and you know how to navigate these environments like a pro, or you're the new trader and you're just trying to build your skill set, right? My goal is to increase the knowledge base of the community. And so as long as we achieve that goal every single week, guys, I am happy as a pig, and you know what? Number two, though, I always like to have fun. I think that life can be difficult. Trading can be difficult. Navigating the market can be difficult. There's a lot of difficult people in the world. Let's not have it here. Let's have some fun together in these sessions as we grow our knowledge base together. And with that said, guys, I just want to say thank you for being the best part of BluSky. Thank you for supporting this trading lab. And we'll do another one next week. Next week, we'll be getting into Bollinger Bands. I'll probably do a secondary indicator on top of Bollinger Bands as well. I will open it up to questions if anybody has any questions, though. Riz, thank you. F, thank you. Gabber, thank you. Thank you, guys. Really appreciate those compliments. Thank you, Snipers. Bucky. Blas. Thank you, brother. The indicator does not allow you to YOLO, though, Blas. I don't know if any indicator does. They're all a little too conservative built for YOLO trading. Lame. Oh, you can get the price. Duke Nukem Trading. We should create a system, Bucky, called the Duke Nukem Trading System. That is a fantastic name. Delayed indicators. Well, you got lagging and leading, right? You got lagging and leading. Most indicators lag price because most indicators will use historical price. But there are some indicators that are so closely aligned with that it's not that big of a deal. I think like RSI, MACD, stochastics, they're all fine indicators. The only real true leading indicator is price, is understanding probability analysis over price. Earnings reports are leading indicators. Economic reports are leading indicators. Leading indicators are indicators that are come out and price moves because of it. Stochastics, MACD, RSI are historically based, so they will slightly lag. But yeah, you need them to confirm everything you're seeing on the chart because there's so many different prices on the chart. There's a lot of different momentum on the chart, and so the indicators can kind of smooth all that out. RQ, I use fibs. I love fibs. In terms of fibs, understanding pullback scenarios, understanding when something can pull back. But like, for example, if you can use in conjunction, like fibs are great for trending environments, right? So when you got a trending environment, where's the pullback zone? Where's the extension zone? Where's the target? Right? Those fibs are great for that. In fact, I love fibs for I think fibs on retracement zones are amazing. But in terms of neutrality, for example, fibs are garbage in neutrality, like garbage in neutrality. What's better than fibs in neutrality? Stochastics. Stochastics is a really good indicator for neutrality. I think MACD better for trending environments, Fibonacci better for trending environments, RSI better for breakouts in trending environments, Stochastics better for I would say a little bit better on neutrality than trending environments. I prefer MACD or RSI or Fibonacci's on trending. But in trending, like I'm so fixated on price action and Fibonacci analysis and wave counting when it comes to trending analysis that these secondary indicators like stochastics take a back seat, honestly. Well, guys, thank you so much for hanging out with me in the BluSky Lab again. We'll do another session next Thursday. This time we're going to be tackling Bollinger Bands, and I'll probably pick a different indicator. As always, it is a pleasure hanging out with you guys here every Thursday, and we'll see you in Discord tomorrow. Later, team.